I find that if you wait too long, the market maker's models or the market maker's brains just say, well, hold on a second. I'm just going to lower my bid from 52 cents down to 51 cents. Or I'm going to join your offer. Or I'm going to offer lower than you. And I think if you hesitate too long and give the market makers too much time to think about it, yeah, not good. You lessen your chances of getting a decent fill. And the way I do that is just simply by going into my live trades and doing what we call a cancel replace and dropping it down by the minimum price increment, in this case, a penny, until I get filled. Middling is a discipline in and of itself, but there's still a bit more to it. And we're going to talk about middling even more.
Hello, Wealth Builders. You're listening to Wealth Building with Options. Here's your host, Dan Passarelli.
Hey, Wealth Building family. Welcome to episode 71, Cash Secured Puts, case study of TGT trade. But before we jump in today, I want to thank the many listeners who purchased my new book, Build Consistent Wealth with Options. If you haven't yet, I know I'm biased, but I think you should. There's a lot of great stuff in there. Some that we covered on this podcast, but there's even more. And if you have purchased the book, please do me a favor, will you? Would you mind leaving a review on the online store at which you bought it? I would really appreciate it. I said it before, but one of the best things about having a career in the markets is that you're kind of forced to pay attention to the world. You have to take in information. It's helpful to keep up with economic, demographic, and social trends, as well as just what companies are doing, how the world is changing. And don't get me wrong, I have periods where I don't keep up with the news as much as I'd like to, but I generally try to keep my finger on the pulse of what's going on in the world. One trend lately is that it's becoming harder for recent college graduates to get a job out of college. Of course, we've heard the drumbeat that AI is taking all the jobs away, but there was a recent study done by the New York Federal Reserve arguing that remote work, not AI, is a major reason why recent college grads are struggling in the job market. The researchers estimate remote work explains about 64% of the increase in unemployment among young college graduates since the pandemic. That's weird, right? Well, it sounds weird until you think about it. The key passage from the Fed's analysis is that employers may be reluctant to hire recent graduates because it's more difficult to teach them the requisite skills from afar. And remote work makes it harder for managers to train and mentor new employees. Not to mention, if they're right out of college, you got to trust that they're actually going to do their work working from home. But back to teaching skills, there's something to be said about hands-on training, or at least realistic training. Not the didactic stuff from college courses, but the real roll up your sleeves, this is how it works in real life kind of stuff. That was the concept behind my latest book, Build Consistent Wealth with Options. There have been tons of books written on covered calls, but they're all just, the upside down hockey stick profit and loss diagrams that show how covered calls and cash secured puts work, and decidedly not how to trade covered calls and cash secured puts. Knowing how something works is different than knowing how to use it. To be great at something, you need both. You need to know how it works and how to use it. And so as I got towards the latter chapters of the book, I added some case studies to a couple of the chapters. I wanted my readers to really understand every step in a specific wheel trade. In fact, I'd go as far as saying I even really wanted the reader to feel what it's like to find and analyze, plan, execute, and manage a wheel trade. And so we're getting to that point in the story arc of this show, if you will, where we're approaching those later chapters. Today, I'm going to share one of the examples that I have straight from the book to make this as real of a trade that you can envision inside your mind's eye. And so, wealth building family, let's spelunk in the cave of option trade reality. We talk a lot about the skate objective and the trade objective. And I say, you got to know which one of those is your objective going into a trade. But is there a sliding scale between the skate objective and the trade objective? Well, the answer is yes. Investors and traders need to accept the risk involved in every trade. The skate's objective means not wanting the options to get assigned. But if getting assigned is unacceptable, it might be better just to not sell the call or put. Conversely, if you sell options in hopes of getting assigned, well, you might inadvertently skate. Whatever the objective, the other outcome is always a possibility. So when the objective is to skate, some of the analysis for trade objective trades should carry over as well. Probably skate objective trades are less concerned with fundamentals and are more technically driven. But factoring in the investment merit of your option being assigned at the strike price makes for a more well thought out trade. With the cash secured put, for example, the capital required to carry the trade is the margin on the put strike anyway, whether hoping to skate or get assigned. Your capital is invested in the trade anyway, so it makes sense to seriously consider the potential of assignment. And in a sense, it's the first step in formulating the trade management plan, right? What happens if the option is assigned? Is that acceptable? If not, can I still even make the trade? If I do, what actions can I take to avoid assignment? And if assignment is acceptable, what action do I take if the option does get assigned? Management, right? When I enter a trade with the skate's objective, I look at it both as a single trade and as part of a cycle. I calculate the skate return on cash for that one trade, and I annualize it to get the skate yield. Even if I don't continue the cycle, I'm thinking about it as if I will do it over and over again for a year. And I probably will repeat the trade. Maybe not over and over again for a whole year, but for as long as the trade rationale is still valid. Further, I want to make money on this trade. But if I don't, I know it's okay, because the trade may be one trade within a larger cycle. And whether or not this trade is only one trade within this cycle is one within many, many more cycles over a lifetime of investing. So let's explore how one might look at a skate objective trade, a cash secured put trade specifically, from setup to execution to management. This is a trade that I actually did, as I recall, in my real account. I think I kind of forget, to tell you the truth. But anyway, here we go. Target Corporation, symbol TGT. Let's say Target stock is trading at $94.38 at the snapshot in time that is the onset of this case study. The 1-year daily chart shows support at $87. Looking back at even longer time frames, that price level has well-established inflection points. A day earlier, the stock crossed above the 50-day moving average around $92 a share, which should act as weak support as well at this point. The 30-day implied volatility on the volatility chart has been rising to be well above historical volatility. That's always a great reminder to identify when the next earnings announcement will be. Now, my first step is always just to go by the date of the last earnings announcement and add 3 months. And in this example, we'll just say it looks like the next one is probably a month away. But I need to be sure. So what I do, and I do this all the time when it looks like the earnings announcement might be within the next month, all I do is I just Google TGT Investor Relations return. And then once I get the results, I click on the events and presentations link. If I don't see that link, I just get to the investor relations site and I find events or presentations. Sometimes it requires some digging, but a lot of the times it just pops up as a link in the search results, which I love. As we move forward with this example, that brings me, in this case, to a web page stating that earnings will be on November 19th before the market opens. BMO. So that's 27 days from this potential trade entry date. Any trade to be considered would have to have an expiration date before November 19th to avoid carrying it through earnings, right? Makes sense? At this point, this is still just a possible candidate for a short-term cash secured put, right? But it's shaping up to be a decent candidate. A cursory look at fundamentals will add to or detract to the state of how strong of a trade candidate it is. So I look and I get these ratio values for this, let's just call it hypothetical example. The PE ratio, I believe, is low. It's 10.94. The price to book ratio is 2.78, which is maybe a little high. And the price to operating cash flow is 6.71, which is pretty low. Now, this whole picture is not like great, but it's definitely not awful. Really, the only thing that seems a little off is that price to book ratio, but the other two are good and there's not really showing any red flags. I sometimes like to also look at the current ratio, which as long as it's 1 or below for most industries, that's fine. And in this case, it's 0.99, pretty much right spot on the money. The market's been climbing for the past 2 quarters in our example. The overall market at the time of the analysis is at a historical high PE ratio of 31.5. And that's the S&P 500 PE ratio. So that indicates that the market overall has been strong and maybe even overly strong, overpriced, and might face a pullback. There isn't a narrative about retail traders or anything else that's out of the ordinary as far as concern goes for trading in this stock at the time. The technicals and fundamentals, no, they check out. Onto the option chain. The option chain will reveal whether it's possible to construct an edge-based trade at this point. The story of this trade really, so far, the key point of this trade is, well, there's technical support at $87 a share, with all the rest of the data acting as like a supporting cast. Shorter term options keep the period of risk short, which is great, and they enable the strike to change with each roll, because every time I roll, I choose what strike I want to roll to. And so I just do that in accordance with market dynamics, and I might have the highest theta by selling those shorter term options, depending on how close to the money the strike price is. For a starting point, let's say I look at the October 31st options, which in this case expire in 9 days. The 87 strike puts are 25-cent bid, offered at 36 cents. That market's a little wide, but probably possible to middle in a stock like Target. But maybe it's just my experience of having done this quite a lot. Intuitively, they're just too cheap, right? The skate return on cash, if I want to actually do the math, is less than 13%. But that's before commission and not taking into account the debit that I'll pay when I close the trade. So I just move on to the November 7th 87 strike puts. These have 16 days to expiration in this example. They're 52-cent bid at 68 cents. So somewhat better, but still not in compliance of my 10% rule that I've talked about on the show in the past. That is my guide for liquidity. That means, and as a reminder, what the 10% rule is that if the offer is more than 10% higher than the bid, it might not be liquid enough to trade. So I just take 52 cents plus 10% of that. So that's about 5 cents, right? So basically 57 cents. If the offer is above 57 cents, which it is, it's kind of a wide market. So that means if I were to trade these, the trade management plan will have to incorporate the fact that there is a little bit of a lack of liquidity here. I may need to consider holding the puts all the way until expiration to avoid giving up too much to the market maker on the exit. That would limit my rolling potential. So it's not really a deal breaker, but these are all the thoughts that would be going through my head on a trade like this. I've got to think about all this stuff. Now, relative to the first one that we looked at, the 9-day trade, I mean, the extra week of time is not some big concern or anything. The puts are nearly 8% out of the money, which I would figure to be far enough for a 16 days to expiration trade in a stock like Target, given the rest of the trade data especially. I'd consider selling a lower strike put in this expiration to add more cushion if it makes sense. But the puts are starting to get too cheap, let's just say, in this 16-day expiration if we go down below the 87 strike. So sticking with the 87 strike, let's presume that it's possible to middle the market and sell those puts that are 52 bid at 68 offer at 57 cents, which would be pretty realistic. That would be a skate return on cash of 0.66%. And thus, if I annualize that, I would get a skate yield of 14.9%. In the market environment at the time, a money market sweep vehicle in a SIPC protected brokerage account could earn about, say, 4%. So I'm making, almost 4 times what I could if I just put it in a money market. So the investment decision is this. Is 14.9% enough compensation for the risk of this stock falling 8% in 16 days, given the rest of this data? And is there a better use of this capital from a return on risk perspective? See how these thoughts really help me to make an optimal decision here? Now, there could be a better target trade hiding in another strike or another expiration. Let's continue on to the next expiration, November 14th. So that would be 16 days to expiration, I guess. We'll start out by looking at the 87 puts, which are 98 cents bid, offered at $1.09. Again, that's pretty much right there with my 10% rule. Presuming a fill price of $1.02 if I middle it upon selling the puts, that ends up being a skate return of cash of 1.2% or a skate yield of 18.6%. Now, that's clearly better. But the risk of the stop dropping 8% in 23 days is more plausible than in just 16 days. The objective is to skate, right? So maybe I would look at a lower strike. If I look at those November 14th 86 puts, well, they give more wiggle room. Let's presume I can sell them at 77 cents. So that's 0.9% skate return on cash or a 14.2% skate yield. That's a little worse of a skate yield than the November 7th 87 puts. And so I'm doing this balance. So it's shorter hold period versus lower strike. All the options being considered have implied volatility above the most recent historical volatility in this example. So that's important too, right? With no known potential catalysts expected to cause the stock volatility to increase, because earnings is after that, volatility analysis indicates these options are overpriced, which is good. As for theta, the October 31st 87 puts, they have the highest theta of all the candidates for this trade, shortest term options, and they're close enough to the money to warrant them having the highest theta. But maybe it's not enough to override the absolute low premium they have. The November 7th 87 puts would have the highest premium of the choices we talked about, notwithstanding that the November 14th expiration, we would be looking at the 86 puts. So, maybe they have the highest premium. So let's just assume that we arrive at the conclusion, giving all these thoughts, that the November 7th 87 puts are the best ones to sell, at least by some small margin. Now, as an aside, we could consider another type of trade. With technically based skate objective trades, there is a school of thought that would rather sell a put credit spread instead of a cash secured put. A put credit spread uses mostly the same trade criteria and logic as a cash secured put, but in addition to the put that would be sold in the cash secured put trade, the trader also buys a lower strike put in the same expiration and probably done at the same time as part of one trade. So basically, you're selling the same put, but instead of holding cash, you're buying a put. So it's a little different. As an example, for this example, the trader might sell the November 7th 87 puts and at the same time buy the November 7th 86 puts, one strike lower. If the trader executes this trade for a net credit of a dime, that would be the trade's maximum profit. 10 cents of option premium is $10 of money times the number of contracts. Now, that's quite a bit less than the 57 cents that one could get for just selling the cash secured put. But comparing one cash secured put to one put credit spread, a one lot put credit spread, well, the maximum risk is greatly reduced when it comes to the credit spread. If you think about it with that risk management hat on. At expiration, the puts involved will either expire or will be exercised, right? If both options are in the money at expiration for the put credit spread, well, the 87 puts would be assigned, resulting in long stock at $87 a share, and the 86 puts would be exercised, resulting in short stock at $86 a share. So buy at 87, sell at 86. We're negative scalping $1 by buying $1 higher than we're selling, but the 10% credit stays in our account. So the maximum loss on this credit spread would be 90 cents. The margin for the credit spread would just be that 90 cents or $90 of money per spread. And that's because that's the most you can lose on this credit spread during this period. Compare that to the $8,700 of margin, right? Because it's the strike price for the cash secured put. $8,700 on the 87 strike for the cash secured put. I mean, that's a big difference. $90 versus almost $9,000. As a result of the lower margin and capped loss feature, traders would tend to trade more credit spreads, while investors tend to be more towards cash secured puts. Because of the nominal amount of cash posted for margin, assignment is then a very undesirable outcome that could add massive leverage to the risk of this trade under exact specific circumstances. If the stock is between the two strike prices and I get assigned on my 87 puts and buy the stock, but my 86 puts expire, well, then after expiration, now I'm long shares of stock. And if the stock collapses coincidentally on Monday, I can actually lose more than what's in the spread. So additional attention and different attention needs to be paid to managing credit spreads as compared with cash secured puts. These are related but conceptually different approaches to this opportunity. They're a different discipline. Though credit spreads are out of the scope of what we talk about on this show, because this is a wheel show, right? And it's a little out of the scope of the book as well. It's still what I say in the book is it's still a useful seasoning in the spice rack. And then thinking through execution, let's go back to what we probably arrived on to be the best opportunity here, the November 7th 87 strike cash secured puts. There's no guarantee that we are actually going to execute them at 57 cents like I was assuming we could in this example. Again, 52 cents bid offered at 68 cents. But with hundreds of contracts of open interest at that strike and nearby strikes within this expiration, the November 7th expiration, it should be possible to sell, not much below the mid-market price. The mid-market point is 59 cents. Experienced middlers are probably going to start the offering at no higher than 58 cents, just a penny below the mid-market. But to be fair, if this was a somewhat less perceived liquid option, like if there was less volume in open interest, I might actually start a little bit closer to the bid in those more illiquid options. But if I put in my 58 cent offer, if it doesn't trade at the price that I first offer it, then I'll just walk it down, as they say. Just take it down from 58 cents to 57 cents. If that doesn't fill immediately, down to 56 cents. If that doesn't fill immediately, down to 55 cents. I find that if you wait too long, the market maker's models or the market maker's brains just say, well, hold on a second. I'm just going to lower my bid from 52 cents down to 51 cents. Or I'm going to join your offer. Or I'm going to offer lower than you. And I think if you hesitate too long and give the market makers too much time to think about it, not good. You lessen your chances of getting a decent fill. And the way I do that is just simply by going into my live trades and doing what we call a cancel replace and dropping it down by the minimum price increment, in this case, a penny, until I get filled. Middling is a discipline in and of itself, but there's still a bit more to it. And we're going to talk about middling even more. I think when we do sort of the part 2 of this case studies, which is probably going to be 2 shows from now. So hang tight. I'm giving you something to look forward to. So now let's move on to the management. Once I sell this put and I get my confirmation, well, the exit plan must go into effect. I use the word must because it must. To be fair, arguably, it's probably best to come up with the management plan even before executing the sell to open trade. But immediately following is okay too. I mean, you should kind of have the plan. The plan is part of the whole big picture that we're looking at, which is why we do the skate or trade objective. But the plan has to go into effect as soon as the trade is executed. Okay, so this financial vehicle is like any other vehicle. Before you start driving your car down the road, well, you need to know where you want to go. Otherwise, why are you getting in the car in the first place? The whole reason for getting into a vehicle, because it's the same word, not coincidentally, but the whole reason for getting into the vehicle we call an option trade is to achieve an outcome. In this case, the outcome we want to achieve is to skate, to grab a quick profit over this 9 or 16 days or whatever, while accepting the risk of the stock moving too much in the wrong direction. Ultimately, hey, all trips are about the journey, not the destination, right? That's what they tell us. Ultimately, it's the same thing with investing, with this kind of vehicle. Investing is about risk management, right? What will you do if the stock does fall through the strike price? I mean, you want to skate. And then what will you do if it doesn't fall through the strike price, which is what you want to do? But will you buy it back? Will you just let the put expire? I mean, let's start there. Probably, as far as do I want the put to expire, that answer is probably no. And that no is not necessarily contrary to the earlier assumption that the option might need to be left to expire because of the illiquid bid-ask spread that we're dealing with in this expiration. So let's unpack what a management plan might look like here. Remember, this is all about return on risk. All investors have limited capital. Yeah, even the big ones, the Warren Buffett types, right? That capital must be employed in the vehicle that reaps the greatest return. Right now, this trade might be capable of earning a maximum of 14.9% annualized return. But wheel trades are not like earning interest in a money market account, steadily earning a bit evenly each day. What happens if and when it becomes clear that this trade is not going to lead to a profit, like we hope it will? Or what happens when the stock rises faster and more than expected, and the majority of the profit is captured from delta in just a small fraction of the expected time in the trade? Well, look, we just entered into the buy to open trade in this hypothetical example. That is the time to answer both of those questions. Let's start with what we might do if the skate objective is going swimmingly as planned. The moment a sell to open wheel trade executes, the first thing I usually do is enter a good till cancel limit order to buy it back at 3 cents or maybe 5 cents or 10 cents, which we talked about on a show probably about 20 shows ago. It depends on minimum price increment of the options, how they trade. It depends on, are we talking about a 52-cent trade or a $50.20 trade, etc. Now, why do I enter the GTC buy to close order right away? Because it's all about return on risk. When I'm short an option, the profit is capped at the options premium that I collect. As the stock price and time and volatility and even the interest rate changes, the option premium changes. That means the maximum profit from that point forward changes. And that means the skate return on cash and the skate yield change. In some other example, some investor sells a 1 month 50 strike put for $1.50. Okay, I did this example because it's easy math. That's a 3% skate return on cash for a month. And it's a 1 month trade. There's 12 months in a year. Multiply 3% times 12. That's a 36% skate yield. Okay. Now imagine the stock rises around $4 over the next week. Remember, it's a 1 month trade. Rises $4 over the next week, and implied volatility falls a bit. And, I collect theta for a week. Well, at that point, maybe the put's trading at like 30 cents. The one I sold for $1.50 is trading at 30 cents. And there's 3 weeks still until expiration. So if I were to keep that trade from that point forward, the math works out to be a 0.6% skate return on cash, 30 cents over 3 weeks. That's only a 10.4% skate yield. This is a very, very different picture from a week ago. A week ago is 36%. Now it's 10.4% skate yield. The skate return on cash is, of course, always going to be smaller when there's less time until expiration, but the annualized skate yield figure balances it out and makes it a truer comparison, which, even though we know we're not going to make this same trade over and over again for a year, that's still why we need to use the annualized figure. The trade doesn't yield nearly as good a payoff as it did a week ago in this 1 month trade example. A lower skate yield doesn't always make the trade decisively worse necessarily, but sometimes it will. At some point, though, the risk reward can become clearly inferior given changes in valuation influences on the put. Imagine another week passes, and now the put is 5-cent bid at 10 cents. At this point, the skate calculations aren't even necessary. The trade that I sold at $1.50 made me $1.40 in just half the time in 2 weeks. It can give me only another dime over the next 2 weeks. I made $1.40 in 2 weeks, and I could make a dime over the next 2 weeks. Obviously, it's possible to find a better use for that $5,000 of capital on that 50 strike per contract than to try and make another stupid $10 per contract on this trade, waiting it out for another 2 weeks. So I entered GTC limit orders to close wheel trades, even if the bid-ask spreads are illiquid. Why? Because taking off unproductive risk makes sense. It's less likely the bid ends up getting filled in illiquid options, but if the likelihood of getting filled, even if it's a long shot, it doesn't make sense not to have the opportunity to close unproducing risk. But when the options are less liquid, there's more nuance. Sometimes as expiration approaches, those small bids, they might not even get filled on way, way, way far out of the money options. Market makers might not have a position in them and really don't want to enter into a position by selling options to you at a couple of pennies that you're trying to buy, even if they're unlikely to ever be in the money. Market makers manage their risk. The more illiquid the options, as in failing the 10% rule or having very low volume or very low open interest, the less likely it is to be able to roll without giving up too much bid-ask spread edge. It can be punitive to give up the edge that's often required to get the trade done in these illiquid options. So sometimes you have to leave the option to expire. So the trader here has a time versus value decision to make, kind of the other way if you think about it. Now, this trader needs to weigh whether it's worth it to close the option by leaving in the bid or just to cancel the bid and reap the whole premium. And we can look at that from a theta perspective. Okay, so next, what about the case in which the stock falls? Well, it can fall just as long as it's not below the strike price at expiration, which would lead to the skate objective not being met. Traders might have to take action in attempting to avoid assignment, of course, and this always involves a balance between delta and theta. Losing on delta is something not very predictable that the trader has no control over. The stock's going to do what it does. But the short option, well, the short option is going to make money on theta very measurably and very predictably as each day passes. Thus, traders need to act to stave off losses or to avoid assignment once the stock crosses the strike price. And I say the strike price, I mean, really, it's whatever the exit trigger is where we have to act to stave off losses. I think it's very common for a lot of traders just to simply use the strike price as that line in the sand. And I do that most of the time myself, for sure. And then I just roll or close the option if the stock moves through it. Some investors, they might wait a day for confirmation across the strike price and closes through it today. And then the next day, if it opens through it, okay, confirmation, now I close it. You know, that's lady's choice. How does an investor decide whether to roll or close? Well, generally, if the skate objective cash secured put has more support below it, and ideally stronger support below it, well, then you can make the case for rolling and still making the case that you have edge. And then, of course, with covered calls, it's resistance. But this is important stuff. We don't roll just for the sake of rolling. There needs to be a technical or fundamental reason for it. If an investor can't roll into a trade that can stand on its own merit, well, then closing the trade's the only rational choice. With the skate objective, cash secured puts are pretty straightforward. At its crudest, it's will the technical study or pattern hold so I can grab some premium? And is the reward worth the risk? And that about wraps it up for this show. But before you go, let's talk about how you can get the most out of the Wealth Building with Options community. First, make sure you're subscribed to the show in your favorite podcast app. And if you're already subscribed to the show, you can go even deeper and get more with a paid subscription. With your paid subscription, you'll get video extra podcast episodes so you can get hands-on video training on things we talk about on the show. You'll get subscriber-only posts where I drill down on a stock, event, or trading opportunity and share trade ideas. You'll get all my covered call and cash secured put trades that I'm making in my real brokerage account. You'll get access to our monthly online Ask Me Anything webinar, and you'll get our unusual options activity alerts on options income trades and much more. And really, the best part is your paid subscription helps keep this show on the air. So I'd like to take a minute to thank our newest paid subscribers. Thank you, John G., for becoming a paid subscriber. Thank you, Oz. Thank you, Scott. Thank you, Chandra. And thank you, Billy C. To join the list of Wealth Building paid subscribers, just go to the Wealth Building with Options Substack page and sign up. The shortcut to that page is wealthbuildingpodcast.com. That's wealthbuildingpodcast.com, and choose a monthly or annual subscription. Or for the best value, become an all-in wealth builder and get everything I mentioned, plus our Friday group coaching and our Smart Income video class, which alone is valued at more than your Wealth Building with Options paid subscription. Again, that's wealthbuildingpodcast.com. Until next time, invest excellently.
Options involve risk and are not suitable for all investors. Before buying or selling an option, read Characteristics and Risks of Standardized Options. A link is provided in the show notes. To learn more about your host, Dan Passarelli, please visit markettaker.com.